welcome grade 11 mindsetters. Yes, today we're going to be focusing on accounting, and I'm sure you guys have your pens, papers and calculators ready, because in today's lesson, guys, we're going to be looking at acquisition and depreciation of assets. Okay, now the word acquisition, let's start with the word acquisition. When we talk about acquisition, we're obviously looking at acquiring. Acquiring means we either buying or the owner is bringing in, the owner is contributing assets to the business itself. Now, what type of assets are we talking about? Here specifically, guys, we are referring to non-current assets. Okay, so we're focusing on the acquisition of non-current assets. We're also going to be looking at depreciation, because we already know from grade 10 accounting that assets, non-current assets specifically, depreciate in time. And which non-current assets depreciates? Absolutely correct, vehicles and equipment. So that's what we're going to be focusing on in this lesson itself. Now, we already spoke about, in this lesson, we will cover, firstly, the definition of tangible assets. Tangible assets, guys, specifically refers to your non-current assets. I've touched on this already. We're also going to look at depreciation calculations, which you've already learned in grade 11. Sorry, not grade 11, but grade 10. And we're going to recap the grade 10 calculations in grade 11. Then recording tangible assets that were purchased by the business. And here specifically, we're going to look at journal entries, as well as how it's going to affect your ledgers, your general ledgers. And then we're going to touch on the tangible asset note that appears in your balance sheet. Okay, so a lot to do in this lesson, guys, but you're going to find that most of the content is grade 10 work, and we're obviously going to be recapping on this grade 10 work because it's absolutely important for grade 11 as well as for grade 12. Okay, so let's get started. Right, let's start firstly with your definition of tangible assets. Now, the definition, guys, you've been through this, I'm sure, in grade 8, but let's quickly, one more time, go through this definition. Tangible assets, such as land and buildings, vehicles and equipment, have a reasonably long lifespan. Now, what do we mean by this? These assets, which assets am I talking about? Your land and buildings, your vehicles and equipment normally will last the business, or the business will have these assets in their possessions for a reasonably long time. And when we talk about long time, we are talking about more than a year. Okay, so more than, let's fix that. Oh, let's fix that. Okay, so more than 1 year. These assets are not purchased for resale. So they're not purchased to resale or sell it to the customers, but rather it's there for the purpose of producing an income for the business. In other words, the business will acquire, the business will buy land and buildings, vehicles and equipment in order for them to produce an income for the business itself. Okay, so let's move on. Let's now look at the word depreciation. Okay, depreciation, tangible assets such as vehicles and equipment lose value over a period of time. In other words, it depreciates. Okay, so for example, if we buy a new laptop for the business, we know over time the value of that laptop is going to diminish. In other words, it will depreciate over a period of time. The accountant or bookkeeper therefore needs to write off depreciation at the end of the financial year. So in other words, in order to show these assets at their correct value, the accountant will, at the end of each financial year, write off depreciation. In other words, depreciation, as we know, is a year-end adjustment. Okay, let's move on. There are two methods of depreciation, and these two methods are, firstly, the cost price method, which is also known as the fixed installment method. And then the second method is your carrying value method, which is also known as diminishing value method. So guys, two methods of depreciation, the first one being the cost price method, and the second being the carrying value or the diminishing value method. Now, before we look at an actual exercise on acquisition and depreciation, let's quickly recap on the actual depreciation calculations of these two methods. Okay, so let's get started with our very first example on depreciation. We're going to start off with the cost price method. Right, let's look at the example that is given to us, or the details rather, and then we'll do the actual calculation. A vehicle with a cost price of 120,000 Rand was purchased on the 1st of March 2012. On the 28th of February 2013, depreciation must be calculated at 20% per annum, and this is using the cost price method. Okay, so we're going to calculate depreciation. Let me just fill it in using the cost price method. Okay, right, let's move on and let's look at the actual calculation for your depreciation. So your calculation will be as follows. Because we're using the cost price method, we are going to use the amount of the actual asset, or the cost price of the asset. We're going to times this by the rate of depreciation, as well as by time meaning the number of months this asset was used for this financial year. Okay, so let's start firstly with amount. Amount specifically refers to, because we're using the cost price method, it's going to refer to the cost of the vehicle itself. So the cost of the vehicle is 120,000 times the rate that we're going to provide depreciation is given to us at 20%. So times 20%, and then time. Time refers to the number of months that this asset was used for this financial year. So if we look at the time, the asset was purchased on the 1st of March 2012, and this financial year ends on the 28th of Feb 2013. So if we look at the number of months that the actual asset was used by the business from the 1st of March 2012 until the end of February 2013, this gives us 12 months. So we're going to depreciate the asset for 12 months, 12 over 12, which obviously will cancel off because we're depreciating it for 1 year. Okay, so let's look at the actual calculation itself. So let's get our calculators out. We're going to take 120,000 multiplied by 20%. It's for 1 year, 12 over 12, which cancels out, which means I'm writing off depreciation of 24,000 for this financial year. So my depreciation would be an amount of, 24,000. Okay, right. So very quickly, guys, one more time. When we're using the cost price method, we're taking the actual cost of the asset, multiplying it by the rate of depreciation as well as the number of months that this asset was used for this financial year. Okay, right, that was the first method of depreciation. Let's now move on to the second method, which is your diminishing value method. Now, your diminishing value method, slightly different from the cost price method. Let's read the example first, and then we'll look at the calculation and see how it differs from your cost price method. A vehicle with a cost price of 180,000, so again we're given a vehicle, cost price this time is 180,000, was purchased on the 1st of March 2010, provide for depreciation at 10% per annum using the diminishing value method for the following financial year end. Okay, so they want us to calculate depreciation for 28th of Feb 2011, so the year end 2011, and then they also want us to calculate depreciation for, just extend the page there, for 28th of Feb 2012. So your depreciation calculation for this particular example is for 2 financial year ends. The first one, 2011, and thereafter 2012. Now let's start off with 2011. 2011, remember, this is your first financial year end. So your depreciation calculation will be as follows. Your cost price of the asset is 180,000. So again, I'm going to need an amount, I'm going to need the rate, and I'm going to need the time. In other words, I'm using art. That's a method that I stick with. Now the amount, cost price, 180,000. Okay, it's the first financial year, so there's no accumulated depreciation for me to subtract. So I'm just using my cost price times your rate, which is given to you this time at 10% per annum, and then the time, which again, because it was purchased on the 1st of March 2010, the first financial year ends on the 28th of Feb 2011. So again, we're looking at 12 months. So time would be 12 months, and again, obviously that would cancel out. So for the very first financial year end, my depreciation calculation would be 180,000 times 10% to give me depreciation that I write off of 18,000. Okay, so that's for the first financial year end. So for the first financial year, obviously the method of depreciation calculation was not different from the previous exercise. That's because it's the first financial year end and there is no accumulated depreciation for us to subtract. Let's now look at what's going to happen on the 28th of February 2012. So for the next financial year, or rather the second financial year end. Okay, again guys, we're going to need amount, we're going to need rate, and we're going to need time. Let's start off with amount first. Because we're using the diminishing value method, we're going to take our cost price, which is 180,000. We are going to subtract the depreciation that was written off in the previous financial year. So the previous financial year, our depreciation was 18,000. So we're going to subtract the 18,000. And then we're going to multiply this by the rate, which is given to us again, just to recap, at 10% per annum. And again, it's at the end of the second financial year. So 12 over 12, which cancels off. So for the second financial year, my depreciation would be, let's get the calculator out. We're going to take the cost, 180,000. We're going to subtract 18,000. And that's going to give us a carrying value of 162,000. We're going to multiply this by 10%. And for the second financial year, our depreciation amounts to 16,200. Okay, so depreciation, 16,200. Let's just double check that. Correct, 16,200. So for the second financial year, our depreciation amounts to 16,200. Okay, so if we look at, again, one more time, the diminishing value method, you're going to take your cost minus accumulated depreciation, and then you're going to multiply it by the rate, and obviously you're going to take time into account as well. Okay, so that's as far as your depreciation calculations are concerned. Again, guys, just a reminder, it's obviously a recap of grade 10 accounting, but it's absolutely important that we remember how to do these calculations, because if we don't, we obviously will struggle with our grade 11 accounting as far as non-current assets are concerned. Okay, right, let's move on, guys. Let's now look at the very first question, where we're going to be completing the tangible asset register. Okay, now again, tangible asset register, something that you definitely came across in grade 10. This is simply an internal document. Okay, it's an internal document where the business simply records the asset that was purchased, where it was purchased from, the make, the type of the asset, as well as the details of depreciation, carrying value, accumulated depreciation, cost price of the asset itself. All of that info goes into your tangible asset register. Okay, so let's read our information, and then we'll obviously complete this tangible asset register. Okay, so we're given the tangible asset register for a business called CC Traders. The make of the asset is a laptop. Date of purchase is given to us as well. So the date of purchase is on the 1st of June 2009. The cost also given to us at 12,000. And then we've got depreciation, which is given to us at 20% per annum on the diminishing balance method. So immediately, diminishing balance method, I'm going to remind myself that when I do the depreciation calculation, this will include taking into account the cost price minus accumulated depreciation. Okay, right. Further down, we've got the following table that is given to us as part of this tangible asset register. So we've got the dates, and this refers to year end, the various year end for this particular asset. Then the depreciation calculation that we need to complete. Accumulated depreciation. Now remember guys, accumulated depreciation is simply the sum of depreciation over a period of time. Accumulate means the sum, adding up depreciation. And then we've got carrying value. Carrying value, you've definitely come across this in grade 10, but again, just quickly a recap. What do we mean by carrying value? Carrying value simply refers to the cost price minus accumulated depreciation. In other words, what's the actual worth of the asset? Okay, right, let's get started. The first financial year end is on the 28th of February 2010. So that's our first financial year end, and they want us to do the depreciation calculation. So let's start with the calculation itself. Again, remember, depreciation, I'm always going to need amount, rate, and then obviously time. Now let's start with the amount itself. The cost price of the asset is given to me at 12,000. And remember, because it's the first financial year, there's obviously no depreciation or accumulated depreciation for me to subtract. So I'm simply going to take my cost price, which is the amount of 12,000. I'm going to multiply this by the rate. Now the rate is given to me at 20% per annum. So multiply it by 20%. And then I get to time. Now be very, very careful here guys, because remember, we need to look at the date of purchase of this asset. Now this laptop was purchased on the 1st of June 2009, which means if we look at the actual financial year, so remember your financial year ends on the 28th of Feb 2010. So 28th of Feb 2010, which means it started on the 1st of March 2009. And now we get to the question, when was this laptop purchased? So it was purchased on the 1st of June 2009. Okay, so 1st of June will probably be somewhere here on the timeline. 1st of June 2009, which means for the first financial year, I've only used the asset for this part of the financial year. So from the 1st of June until the end of February. Now remember guys, absolutely important that when you count, you do not make a mistake with the number of months that this asset was actually used for. So we're starting with the month of June. So June, July, August, September, October, November, December, January, and February. In other words, the asset was used for 10 months. Okay, so one more time, we're looking at obviously from the month of June until the end of February. So June, July, August, September, October, November, December, Jan, and February. Okay, now guys, did you notice something? I obviously made a mistake, isn't it? That normally happens. You can make a mistake with the counting of your months itself. So it's obviously not 10 months, okay, but rather it's 9 months. Okay, so this asset was used for 9 months. So let's go to our calculations. Times, okay, 9 over 12. Okay, right, let's get the calculator out so we can calculate the depreciation for the first financial year. So we're taking our amount, which is 12,000, times the rate, which is 20%, and then times the number of months. We've only used the asset for 9 months, so 9 divided by 12. Let's fix that. And that gives us a depreciation amount of 1,800 for the first financial year. Okay, so let's fill that in. Our depreciation is an amount of 1,800. Okay, right, let's move on to the next part of the table, accumulated depreciation. So this is the first financial year, which means we don't have any previous accumulated depreciation. So the accumulated depreciation is the same as the depreciation, an amount of 1,800. Now let's go to carrying value. Carrying value, one more time, refers to the actual worth of this laptop, what it's worth on the 28th of February 2010, in other words, 9 months later. So the worth of the asset is my cost minus accumulated depreciation. So the cost of the asset is 12,000 minus accumulated depreciation that we've written off is 1,800, which means this laptop is now worth, okay, so 12,000 minus 1,800, it is worth 10,200. Okay, so the laptop is worth, let's write it down, 10,200. Right, so that was obviously at the end of the first financial year. Let's now look at what happens at the end of the second financial year. So the second financial year ends on the 28th of Feb, and now we're moving on to 2011. 2011, again, depreciation calculation first. So your depreciation, we're going to start off with the amount, and the amount, remember, is going to be calculated by taking my cost price, which is 12,000, minus my accumulated depreciation from the previous years, which is 1,800. I am then going to multiply this by the rate, which is 20%. And remember, the end of the next financial year, you've obviously owned the asset for the entire year. In other words, you've owned the asset from the beginning of the year, which would have been the 1st of March 2010 until the end of February 2011. In other words, you've owned the asset for that entire 12 months. So times this by 12 over 12, which obviously will cancel out. So let's get the calculator out and let's look at the calculation. So we're going to take our 12,000 minus my accumulated depreciation, what I've written off in the previous financial year, okay, and that gives me the carrying value, 10,200, multiply this by 20%, and for the second financial year, my depreciation is an amount of 2,040. So the second financial year depreciation amounts to 2,040. Right, let's now look at accumulated depreciation. Previous financial year, it was 1,800, but I'm now going to add on 2,040 to work out what is my new accumulated depreciation after updating depreciation. So let's get the calculator out. Your accumulated depreciation was 1,800. We're now adding on depreciation for this financial year, which is 2,040, and that gives us 3,840. So my new accumulated depreciation is an amount of 3,840. Okay, so accumulated depreciation is obviously the addition of depreciation over a period of time. Let's now look at the carrying value. What's going to happen to the carrying value? The more I write off depreciation, the carrying value obviously decreases. So my carrying value, it was worth 10,200, but I've obviously written off additional depreciation. So my carrying value now would be, again, cost, which is 12,000 minus accumulated depreciation, 3,840, and my carrying value is now, let's clear that, 12,000 minus 3,840, so the carrying value 8,160. Okay, so let's write that down. 8,000, let's go back there, 160. Okay, so that's my new carrying value. Okay, right, we've got 2 more years to go, and let's now move on to the third financial year. The third financial year, guys, 28th of February 2012. Okay, so for the 2012 financial year, your depreciation calculation again will be as follows. So I'm going to take again my 12,000, which is the cost, minus accumulated depreciation 3,840, in other words, carrying value. So the carrying value of this asset is 8,160. So I'm going to take 8,160. Again, guys, it's simply cost minus accumulated depreciation. Times this by the rate, which is 20%. And remember, your third financial year, again, you would have owned the asset for the entire year. So times 12 over 12. And for this year, my depreciation would be as follows. So 8,160 times this by 20%. And it's obviously 12 over 12 cancels off to give me 1,632. So my depreciation 1,632 for the third financial year. Let's now look at accumulated depreciation. My accumulated depreciation was 3,840, but I've now added on, or I've written off rather, an additional 1,632. So accumulated depreciation total is now going to increase. So my new accumulated depreciation is simply going to be 3,840, add on 1,632 to give me 5,472. Okay, so let's write that down. 5,472 is my new accumulated depreciation. Okay. Right, let's now look at carrying value. Carrying value again is obviously the cost, which is 12,000. Okay, 12,000 minus the accumulated depreciation 5,472, and this laptop is now worth, let's move that across. Okay, so 12,000 was the original cost, but now we've written off a total accumulated depreciation of 5,472. So the laptop is now worth, or the carrying value is now 6,528. So let's write that down. 6,528. Okay, I'm sure you guys are getting the hang of this now, and all the concepts that you did in grade 10 is obviously coming back. Right, let's now look at the final year calculation, which is 28th of February 2013. So we now are looking at the 4th year. So again, depreciation, we're taking our cost minus accumulated depreciation or carrying value. The carrying value of the asset from the previous year was calculated at 6,528. Again, we're going to multiply this by the rate, 20%. It would have been used for the entire financial year, so 12 over 12, which obviously is going to cancel out. And for this financial year, we're going to write off times 20%. So we're writing off, let's just fix that quickly, 6,528 times 20%. We're going to get some cents here. So we're going to write off depreciation of 1,305 Rand, or let's just round it off to the nearest Rand. So 1,306. Okay, 1,306 Rand is our depreciation that we are writing off. Accumulated depreciation is now going to increase by the new depreciation that we've just written off. So all we're doing again is we're simply adding 1,306 to get our new accumulated depreciation balance, which will be, so we're simply adding 5,472 to get a total of 6,777, but remember we're rounding off to the nearest Rand, so 6,778. Let's just do that calculation one more time. Just going to move this. So we're taking 5,472. We are adding 1,306 to get 6,778. Okay, 6,778. Right, and then finally, the carrying value at the end of the fourth year, this asset is now worth, so again, cost price, 12,000 minus accumulated depreciation, 6,778. So this asset is now worth, or it has a carrying value of 5,222. Okay, so 5,222. Okay, so obviously the asset, as we've noticed, the value of the asset has decreased over the years. In other words, once you write off depreciation, the asset value is going to diminish. It is going to decrease. Okay, guys, we've come to the end of the first example where we completed the tangible asset register. We've recapped on various concepts that you have covered in grade 10, but like I mentioned earlier, you've got to remember how to do these calculations before you can move on to grade 11 accounting. Okay, I think it's time for us to have a quick break. So if you want to go and get something to eat, or you want to go and get something to drink very, very quickly, because you don't want to miss the next exercise where we're going to be focusing on the general ledger and the tangible asset note. So I'm going to see you right after the break. Welcome back, grade 11s. Just before the break, we looked at the tangible asset register, and now we're ready to look at an actual exercise where we're going to do the general ledger and we're going to do the tangible asset note as well as calculations. So let's get started. In this question, which is our second question, we are required to complete the following. So we are told the information below was extracted from the accounting records of CC Wholesalers. You are required to complete the following ledger accounts for the period 1st March 2010 to the 28th of February 2011. In other words, we are given the entire financial year, and they obviously want us to complete some general ledger accounts. All accounts must be properly balanced or closed off at the end of the year. Right, let's look at which accounts they want us to complete. So further down, we've got vehicles, then accumulated depreciation on vehicles, and the last account is depreciation. They also want us to complete the tangible asset note for the year ended 28th of February 2011. So in other words, guys, in this question, we are given only one asset, which is vehicles. We're going to be completing ledger accounts and then the tangible asset note or a balance sheet note. So let's get started. Let's read through the rest of the information and then we'll obviously get started with the question itself. Right, the information that is given to us. The following balances appeared in the general ledger on the 1st of March 2010. So immediately I know 1st March is the beginning of the financial year. So I've got vehicles, an opening balance of 80,000, and then accumulated depreciation on vehicles, an opening balance of 16,000. So I'm just going to make a note. These are my opening balances. Then further down, we're now coming to the actual adjustments and additional information. On the 31st of December 2010, so this is obviously during the financial year, a vehicle with a cost price of 120,000 was purchased from VW Traders on credit. So immediately there's my acquisition. Okay, so there's my acquisition of additional vehicle. Then I'm told on the 28th of February 2011, depreciation must be calculated at 15% per annum, so that's my rate, on the carrying value or diminishing value method. So immediately when I see the word carrying value, I'm going to remind myself I need to take cost minus accumulated depreciation, and that obviously gives me carrying value. Right, guys, that's the info. Let's now look at the answer sheet and then we can obviously start answering this question itself. So my answer sheet, I've got my ledgers, vehicles, then I've got accumulated depreciation on vehicles, the last ledger account, which is depreciation, and then there's my tangible asset note. Okay, so let's get started. We're going to start with opening balances. So let's go to the information that was given to me right at the beginning of the exercise itself. Following balances appeared in the general ledger on the 1st of March 2010. So let's bring down these opening balances. So let's start with vehicles. Vehicles has an opening balance of 80,000. So let's take that through to our ledger account. So vehicles, I'm going to remind myself it is an asset. All assets always has a debit opening balance at the beginning of the year, which is 1st of March. And it's the financial year 2010. Let's just quickly double check. Yes, it is. Okay, 1st of March 2010. So we bringing down a balance at the beginning of the year, balance brought down, and my vehicles has an opening balance of 80,000. Okay, right, next opening balance is my accumulated depreciation on vehicles. Accumulated depreciation on vehicles is obviously an asset, but remember, it is what we call a negative asset. A negative asset simply means that it decreases the value of the asset. So the opening balance is going to go onto the credit side. So on the credit side, on the 1st of March 2010, again, we are bringing down a balance. So balance brought down. And my opening balance for accumulated depreciation is an amount of 16,000. So let's take that through. Opening balance, 16,000. 16,000. Okay, right, done with the opening balances. We're now ready to go to the actual transactions. So back to my info. Okay, done with the opening balances, and let's go to the first bit of additional information. On the 31st of December 2010, during the financial year, a vehicle with a cost price of 120,000 was purchased from VW Traders on credit. Okay, so immediately back to my ledger account, and we're obviously looking at acquisition of a new vehicle. We've purchased a new vehicle, so my vehicle balance is obviously now going to increase. I'm going to have more vehicles in my business, so my assets are going to increase. So on the debit side, my assets will increase by the cost price of this new vehicle, which is 120,000. This vehicle was purchased on credit. So if we go back to the information, they tell you it was purchased on credit, which means the journal that this would be recorded in would be either the creditor's journal or the general journal. So your folio reference, I'm just going to put here general journal. Okay, but like I said, it could be creditor's journal. Your contra account or your details purchased on credit, so you're now owing money to creditors. So your details will be creditor's control. Okay, and the actual date of purchase, let's go back to the info. It was purchased on the 31st of December 2010, so we've got to fill that in as well. So purchased on the 31st of December 2010. Okay, simple. Okay, not difficult at all, guys. So I've now recorded my acquisition or the purchase of this new vehicle. Right, let's now go to our next bit of information. Okay. Right, my next transaction on the 28th of February 2011. So immediately I know this is obviously now at the end of the financial year. Depreciation must be calculated at 15% per annum on the carrying value method or the diminishing value method. Right, now guys, let's now look at this calculation. Now immediately, your depreciation calculation when you purchase new assets is going to be slightly different from the calculation of depreciation that we did in the first exercise. Okay, what do I mean by it's going to be different? It's going to be slightly different, not difficult. We've obviously got old vehicles in the business, and we've also purchased a new vehicle. Now, because of the time difference, we've obviously purchased the new vehicle during the financial year. The old vehicle was obviously purchased in a previous financial year. We need to show our calculations separate. We need to calculate the depreciation separately. So let's start firstly with the old vehicle. Now, the old vehicle, again, we're going to need amounts, we're going to need the rate, and obviously we're going to need time as well. Now, the old vehicle, where do I get the amounts for the old vehicle? Let's go to our ledgers. Okay, my old vehicle, which would obviously be my opening balance, I brought down a balance of 80,000. So that 80,000 is regarded as the old vehicle, the vehicle that you had from prior years. Let's now look at accumulated depreciation. How much of depreciation in total have you written off on this old vehicle? So you've thus far written off 16,000. So these amounts obviously belong to your calculation of depreciation on the old vehicle. So let's go back to that calculation. Okay, so on the old vehicle, we've got the cost price, which is an amount of 80,000. But because the depreciation method is the carrying value method, I cannot only use cost. So I need cost minus accumulated depreciation. So the 80,000 minus 16,000. Okay, I'm going to then multiply this by the rate of depreciation, which is given to me at 15%. And then time, because it was the old vehicle, I've obviously used it for the entire financial year. So 12 over 12, which obviously will cancel out. My depreciation on the old vehicle will be as follows. Let's just move that. Okay, so we've got 80,000, which is my cost, minus 16,000. So it's got a carrying value of 64,000. 64,000 times the rate of 15% or at 15% will give me a depreciation that I've got to write off 9,600. Okay, so let's fill that in. My depreciation, 9,600. Let's just quickly double check. Absolutely correct. Okay, so that's as far as your old vehicles are concerned, or your old vehicle is concerned. Let's now look at the new vehicle. Okay, now the new vehicle, again, we're obviously still sticking with amount, rate, and then time. Let's start with the amount. Now remember, we're obviously using the diminishing balance method, but because it's a new vehicle, we haven't written off any depreciation as yet. So although the question wants us to use the diminishing balance method, as far as the new vehicle is concerned, we will still be using the cost price method. There's no accumulated depreciation to subtract or to take into account as far as the calculation is concerned. So let's start off with the cost. The cost of this new vehicle that we've purchased, so if we go to our ledgers, the new vehicle, the cost price is 120,000. Okay, so the cost, 120,000. All right, remember, no accumulated depreciation to subtract. The rate is 15%. That's what it's given to me at. And now let's look at time. So very quickly, I'm going to draw our timeline. The financial year starts on the 1st of March 2010 and ends on the 28th of February 2011. So that's my timeline. This vehicle, let's look at when this vehicle was purchased. So the information at the top tells me the vehicle was purchased on the 31st of December 2010. So 31st of December, somewhere here. Okay, which means for this financial year, I've only owned the vehicle for this period of time. So not for the entire year. It was only purchased on the 31st of December, which means I've only used the vehicle for the months of Jan and February. So I can only depreciate this asset for 2 months. Okay, now the common mistake that we find that grade 11s make is when they see 31st of December, they forget it's at the end of December, and by mistake, they sometimes include the month of December in their calculation. In other words, when they do the actual calculation, they calculate depreciation for 3 months instead of 2 months. So guys, just be aware of that. Be aware that you do not make that mistake. So it's only for the months of January and the month of February. In other words, 2 months. So I'm going to calculate depreciation for 2 months for this financial year. Okay, so now let's look at the actual depreciation that we're going to write off on this new vehicle that we've purchased. So we're going to take our 120,000, not 12,000, times the rate, which is 15%. Okay, and remember, we are only providing depreciation for 2 months, so times 2 divided by 12. So I'm going to write off 3,000 Rand. That will be my depreciation on the new vehicle. So let's fill that in. My depreciation is an amount of 3,000. Okay, let's now look at what then will be your total depreciation that we're going to write off for this financial year. Your total depreciation is simply going to be the sum of old plus new. In other words, my old vehicle, the depreciation is an amount of, let's go with green, 9,600. I'm simply going to add the 3,000 to get my total depreciation an amount of 12,600. Okay, so that's my total depreciation for this financial year, the old plus the new. Right, now that we've done the calculation, remember we've got to complete the ledger accounts, so let's now go to your general ledger. Okay, right, the accounts that will be affected by the 12,600, I'm just going to write that amount here so that we don't have to go to the previous slide. So that's the amount that we just calculated. Remember guys, this is obviously a general journal entry. That's where you're going to make the actual entry for this 12,600. We're not doing the actual journal entry, but we're looking at the ledgers that are going to be affected. So the accounts that will be affected will be depreciation as well as accumulated depreciation on vehicles. Remember, we are going to debit depreciation. Depreciation is obviously an expense for the business. So on the debit side, debit depreciation with 12,600, and which account then gets credit? Absolutely correct. We're going to credit accumulated depreciation on vehicles because the value of your depreciation is going to further decrease by 12,600. So debit depreciation, credit accumulated depreciation. Let's now fill in the other details in the ledger. So this is obviously a general journal. That's your folio reference. Your contra account would be accumulated depreciation on vehicles. And remember, this is happening at the end of the financial year. Depreciation is a year-end adjustment. So on the 28th of Feb 2011. So let's now fill in our details here. So again, general journal details would be depreciation. Okay, and 28th of Feb 2011. Okay, now something else guys that's absolutely important, and I'm sure you're going to hear this from your teachers, you're going to hear this from your tutors, you're going to hear this from me as well. You need to remember to show bracket work. Now, how did we get this 12,600? Yes, we did a calculation on the previous page, but it's always important to actually show your bracket work on the face of the ledger accounts itself. So if we go back to how did we get the 12,600, it was obviously a sum where we added 9,600 plus 3,000. So I'm simply going to take these figures through to my ledger. Okay, and I'm going to show a bit of bracket work. So this amount was calculated by me taking 9,600 plus 3,000. Okay, and that's how I got the 12,600, and I'm going to do the same here as well. Okay, so 9,600 plus 3,000, and that is how we obviously got the 12,600. So in the event of you getting this total incorrect, you can obviously get some part marks by showing bracket work. So please remember that. Okay, right, almost at the end of our ledger accounts. Remember, the question wanted us to balance these accounts or close off these accounts at the end of the financial year. So let's start off with depreciation first. Depreciation is an expense, and we know from grade 10 accounting that all expenses are closed off to the profit and loss account. So at the end of the financial year, we are simply going to close off 12,600, and by means of a general journal entry, we are sending this to an account called profit and loss, a final account, profit and loss. And this obviously happens at the end of the financial year, 28th of Feb 2011, and depreciation is now closed off. Let's now go to the other two accounts. Okay, let's start off with vehicles. Vehicles is an asset, and this account cannot be closed off, but rather it needs to be balanced. So let's balance this account. Okay, the total value of vehicles, or your total cost price of vehicles, is now 80 plus 120,000 to give you 200,000. So that becomes your new balance. Okay, 200,000. And this is obviously at the end of the financial year, so 28th of Feb 2011. So we've got balance carried down at the end of the year, 200,000. And remember, balance carried down, we've got to obviously take it back to the debit side. So on the 1st of March, which is the next financial year, 2011, we're going to start off the financial year, balance brought down 200,000. Okay, so this account is now completed. Right, the last account for us to look at is accumulated depreciation on vehicles. Again, this account also needs to be balanced. It cannot be closed off. So let's now work out what our new balance is. Okay, so I'm just going to use the calculator here. So we had a balance of 16,000. We wrote off a further 12,600. So my new balance for accumulated depreciation now becomes 28,600. So let's fill that in. So our new balance is 28,600. Okay, let's take that through to the debit side, 28,600. Okay, and this obviously becomes my balance carried down at the end of the financial year, 28th of Feb 2011. And again, 1st March 2011, I'm now going to start the financial year, the next financial year, with my new balance, which is 28,600. Okay, right, done with the general ledger. Now let's move on to the next part of the question, where they want us to complete the tangible asset note. Right, for your tangible asset note, again guys, just a quick reminder. Remember, this is obviously a balance sheet note, and it's obviously completed at the end of the financial year, and it's part of your financial statements. But let's specifically look at the tangible asset note, because it's obviously linked to whatever we've been doing thus far. Right, the format, very quickly guys, remember the format of this note is something that you need to learn. You need to learn off your format, and once you know the format, then it's simply filling in figures. But without the format, you're obviously not going to know which figures to fill in, so please learn your format. Right, the format of this note starts off with carrying value at the beginning of the year. In other words, what are your assets worth at the beginning of the financial year? Now remember, we're obviously dealing with vehicles. That's the only asset or the only fixed asset that we're dealing with in this particular question. So we're going to start off with the cost price at the beginning of the year, and also what is the accumulated depreciation at the beginning of the year. So the first part of your note deals with beginning of the financial year. Then the next part of this note, we then move on to movements. Okay, now movements simply means what happened during the year. Okay, so during the financial year, there could be additions, acquisitions, purchase of new vehicles. There could be disposals, and there obviously will also be depreciation. So this happens during the financial year. Yes, I know depreciation obviously happens at the end of the financial year. Right, so this movements deals with during the year. And then finally, we're now looking at end of the financial year. So what is your carrying value at the end of the year? In other words, what is the cost at the end of the year? What is your accumulated depreciation at the end of the year? So if you look at this actual note, grade 11s, it's very similar to your general ledger. The only difference is the format is slightly different for the actual note, because your general ledger also has a balance at the beginning of the year, what happened during the year, and then a balance at the end of the year. So your note is simply your general ledger, but in a different format. So please remember that. So if you can do the general ledger, the note is obviously very, very simple. Right, let's start filling in this note. We're going to start off with carrying value at the beginning of the year, and in order for me to get carrying value at the beginning of the year, I need my cost at the beginning, I need my accumulated depreciation at the beginning. So if I go to my information, at the beginning of the year, vehicles, 80,000 is my opening balance, accumulated depreciation is 16,000. Okay, so let's take that through to the note itself. Beginning of the year, cost 80,000, accumulated depreciation is going to decrease the value of my asset. So in brackets, it's a negative figure, 16,000. So the carrying value, the actual worth of my vehicle at the beginning of the year is an amount of 80,000 minus 16,000, and this vehicle is worth 64,000. So let's fill that in, 64,000. Right, let's move on. Movements. What happened during the year? Firstly, additions. Did we buy an additional vehicle during the year? Yes, we did. We came across that already. So let's go back to the transaction that tells us how much of vehicles was, or what was the cost price of the vehicle that was purchased during the year. Your cost price, 120,000. So let's take that through to the note. Okay, so movements, addition, 120,000. Okay, and remember, this is not in brackets because this is obviously going to increase the carrying value of my vehicles. Right, disposals at carrying value, we haven't come across any disposals in this exercise. Depreciation, what was my depreciation for the year? I'm not going to do the calculation for depreciation, guys, because we've done that already. So if we go back to the information, okay, we've done the calculation already. Your total depreciation was 12,600. So we're simply going to fill that in. Total depreciation, an amount of, in brackets, 12,600. And again, try and show some bracket work just in case you get this amount incorrect. So in brackets, How did I get my depreciation? I took 9,600 plus 3,000. Okay, and that's how we got the 12,600. Right, next part of the question, what is your carrying value at the end of the year? So in order for me to calculate carrying value at the end of the financial year, all I'm doing, guys, is I'm taking carrying value at the beginning of the year. I'm then going to add additions, what I purchased during the year, and I am going to subtract the depreciation that I've written off for the financial year. Okay, so let's do that. Carrying value at the beginning of the year is 64,000. I've then purchased a vehicle with a cost of 120,000. Okay, but I've also written off depreciation, so the carrying value is going to decrease by the depreciation for the year, 12,600. To give me a carrying value at the end of the year, 171,400. Okay, so 170, let's go back there, 71,400. Okay. Right, so that is my carrying value at the end of the financial year. Then, guys, the last part to this actual note, we're now doing what I like to call a recon. So we're simply going to check whether this total is correct. So we're going to take our cost at the end of the year as well as accumulated depreciation at the end of the year, subtract these two amounts to see if we still get a carrying value at the end of the year of 171,400. Okay, so let's start with our cost at the end of the year. Right, for that, I'm simply taking my cost at the beginning of the year, and I am going to add my addition during the year. So at the beginning of the year, our cost was 80,000. We did purchase an additional vehicle for 120,000. So my cost at the end of the year is 200,000. Okay, now let's just quickly double check that. Let's go to your T account, your vehicle's T account. This 80,000, remember, was the beginning of the year. We then purchased an additional vehicle for 120,000, and at the end of the year, my vehicles obviously has that balance of 200,000. Okay, so remember what I said earlier on? It's simply, the note is simply your T account, but in a different format. Okay, so 200,000. Let's now look at accumulated depreciation at the end of the year. How am I going to get this total? Quite straightforward, guys. I'm going to take my accumulated depreciation at the beginning of the year, which is 16,000. I am then going to add additional depreciation that I've written off during the financial year, which is my 12,600, and that's going to give me my accumulated depreciation at the end of the year. So let's get our calculators out. 16,000 was my balance at the beginning. Add 12,600 to give you your balance at the end of the year, 28,600. Okay, so end of the year, 28,600. Okay, right, so let's get our calculators out again. We want to check whether this carrying value total is correct. So I'm taking my cost at the end of the year, 200,000, minus 28,600 to give me 171,400. Okay, which means I didn't make a mistake. It's absolutely correct. Okay, guys, we've come to the end of the second question, and I think that's all we have time for. Remember, guys, you've got to sit, practice your depreciation calculations. The more exercises, the more examples you do, the better you get at this. especially when it comes to the next section, which is asset disposal. You cannot do asset disposal without going through your grade 10 accounting, your depreciation calculations, as well as the ledger accounts that we've done in today's lesson. Okay, I hope that you've learned a lot, and that you are definitely going to practice. Good luck, guys, and see you next time.